Hey, good morning. Hope everybody's doing well. Happy Easter, Passover, all that good stuff. I hope you're gonna have a good holiday. Hope you've got your taxes done. Due date being Monday. You can see my office a little busy in the back. People walking around, so crazy. People, a lot of people waiting till last second this year. I think it's because IRS has extended deadlines in the past 2 years. So I don't think a lot of people know that the deadline is Monday. So going to be a lot of surprise people. So we had a lot of people come in April, dropping their stuff off. So it's been just nuts, crazy. Anyway, today we're going to talk a little more about, we're just going to update on bonds. The last presentation I gave, I talked a little bit about bonds and said that's what you have to look at. Bonds are the 800-pound gorilla in the financial markets. Everybody looks at stocks. Everybody talks about stocks. And right now when real estate prices are where they are, people talk about real estate. But the reality is everything is predicated off of bonds. Bonds is the power. They're not sexy. They're boring, but they control the game. And you've got to watch what's going on in the bond market. And what's been happening recently has not been very good. So just going to kind of update on that. Even since the 2 weeks since I did the last presentation, the bonds have continued to lose value, meaning yields have gone up. So it's been a crazy environment. And what's going to happen? Where does this lead to? So let's kind of just jump right in, get into the slides. I love my slides. Okay. So, I'm going to start off a little bit just talking about the dual mandate that the Federal Reserve has. So most central banks are really focused on keeping price stability. For whatever reason, back in the 70s, they added a mandate to the Federal Reserve to also look at having maximum employment. So the Fed technically is got to look at not just keeping prices solid, but also making sure people have a job. I don't know why they did that, but I think it just gave the Fed wanted more opportunity to do what they wanted to do. So they just gave them a little bit more responsibility. That's the only reason I can think of. It doesn't really make any sense. I mean, all the central banks were basically created to backstop the banking system. That's really ultimately what they're doing. I mean, it's kind of like when we went to war in Iraq and they had all these reasons why we did it, but the real reason was oil, right? I mean, everybody knows that. And the Fed was created, they talk about maximum employment and they talk about, keeping prices reasonable and stable, but the real reason it's a backstop to the banks. And I'm going to actually do another presentation on the Fed. I've done a few of them in the past. I'm going to do another one just to dig a little deeper so you can really understand more about it. But anyway, so the Fed's looking at the current situation, and obviously prices are not remaining stable. Prices are not, we got massive inflation. But the Fed is in a pretty good spot as far as the other mandate, as far as jobs and workers. So the top part of this graph is kind of what you want to look at. And the orange line is job openings. And the blue line is the unemployment rate. So you can kind of see that, like right now, there's clearly enough jobs out there, at least based on the official data, in the employment rate. So there's plenty of jobs for folks that aren't getting filled. We need more workers. So the Fed can actually start to do some stuff here, that knowing that if a few companies end up having issues, meaning they go under or something like that, that the workers at those companies can easily migrate over to a new job. It's not going to be a problem. So at least one of those mandates has been or can be satisfied. The Fed's not worried about it. They're clearly worried about prices, though. They have to be. Again, I'm not showing you anything that you don't already know, but just over the past 3 years, you can see month over month change in the inflation rate. And obviously when COVID hit, prices actually dropped. But I mean, it's been enormous. It's been an enormous increase. And I actually think no matter what, it'll moderate. Like you're not going to hear of 8.5% inflation, based off year over year. But even if prices stay where they're at, just think about how much more of people's paycheck is going to just the staples. So they clearly have to get inflation under control. And I've been saying here for a while now that I honestly believe that the Fed is at a point, they have such political pressure from the Democrats that they've got to attack inflation. They have to. And even if it means that this heroin that they've been giving to the stock market for a better part of 15 years now, it's going to come to an end. So they're going to sacrifice the stock market in order to make sure that prices start to come back down and we get back to that one mandate of stable prices. And the only time that they'll probably change it is if unemployment situation gets bad. Then they'll say, oh, all right, so we've kind of helped on the price front, but we got to worry about the unemployment. Or if just things break, if the financial system breaks. That's the other thing that could obviously step them back in. But I don't think a 20 or 30% decline in the market this time is going to do it. And if you have been looking, the Federal Reserve governors have essentially been saying this. Now, talk is cheap. Everybody's heard that before. So maybe they're just trying to talk and hope that that'll have the effect that they're looking for to maybe moderate prices in some fashion. But it's pretty clear, these three Fed governors right here are essentially saying that we are going to fight this. So I'm going to take them at their word right now, and also just factoring in again, like I said, it's a election year. So I don't think the Democrats want to go into November with 8.5% inflation because they're going to get smashed. I mean, big time. And the thing is, the Fed is already way behind the 8 ball on this. This chart essentially shows the Fed's fund rate and the consumer price index year over year. And we've been very lucky since essentially 2006 in that we haven't had that high of inflation. So the Fed has had kind of the wind at their back a little bit. They didn't have to raise their rate, the federal funds rate, that high because inflation kind of kept in check with where they were positioned with the federal funds rate for the most part. But now you can see that deviation is just massive. I mean, it's enormous. I've talked about it before. The Fed governors all the way back to Arthur Burns in the 60s, they came up with some metrics. What's it called? It's escaping me right now. The Taylor rule. So the Taylor rule was by Fed governor and basically was created and using this calculation that they could figure out what interest rate that the Fed needed to be at in order to have price stability. And the Fed used this for years to bring rates down, saying, well, the Taylor rule says we don't have to be that high, so we're coming down. It provided a lot of liquidity, a lot of juice to the stock and real estate markets. Well, if they stuck with their guns and still continued to use the Taylor rule, the interest rates right now would have to be over 9%. The Fed's fund rate. So that probably means if you had a normal bond market, if the Fed's fund rate, the overnight rate's at 9, you would think that, 5, 10, 20-year bonds would be even higher than that. So clearly, it's not convenient for them to use their tried and true methodologies. They don't. But that just gives you kind of an idea how far behind the 8 ball they are here. And this gives you sort of the 10-year treasury minus inflation. This is sort of what you're earning on a treasury right now if you bought a 10-year. And you can see that, I mean, it's atrocious. It's even below where it was in the 1970s and early 80s. So, you really got a situation here that needs to be addressed. And I think they're going to address it. I really do. But there is a contingent of folks out there saying the Federal Reserve is just jawboning. They're trying to control it with saying they're going to raise rates, but when it really comes right down to it, they're not. And the reason that they're not is we can't afford to have higher rates. We just can't. This is, you've probably seen this. This is the debt clock. We're well over $30 trillion of debt now. And the biggest thing to look at is the bottom graph, the one where it shows the U.S. federal debt to GDP ratio. In 1960, we had 53 cents of debt for every dollar of economic activity in the U.S. It dropped down in the 1980s, early 80s to 34, and it's been climbing ever since. Now we're well over 125% debt to GDP. And the only time we've ever had a debt at that level compared to GDP was World War II. And as soon as the war ended, that basically corrected itself so that by 1980, it essentially came down from 125 all the way down to that 34% in 1980, which was sort of the low mark. And then it's been going up since then. Now, the thing is, back in World War II, it was pretty easy to cut federal spending. You reduced the military budget. There was millions of men leaving the payroll, and obviously didn't need as much supplies and didn't need the tanks and the planes and all that stuff as much. So it was easy to bring that ratio down. They just waste money now. Where are they going to cut? There are places to cut, but they're not going to. The other reason they just can't afford to have higher rates is these are the biggest expenses that the U.S. government has right now. And you can see, obviously, Medicare, Medicaid, Social Security, and then the Defense Department are the biggest three. But right behind that is interest on the debt. So, you talk $430 billion, and that's at these low rates, sub 2% rates. Can you imagine if we went to 4? What if we went to 8? What if we got back to where we were in 1980, where there were double digits? You could see that we just can't do it. It just can't be done. So a lot of people just think that the Fed, while trying to slow the erosion of our dollar, trying to stem inflation with their words, that really they can't. They have to have inflation. We have to inflate ourselves out of this debt. That's the only way we can handle it. And I've mentioned this in the past. So if you haven't soiled your pants already, this graph will probably do it. But it shows you kind of what the unfunded liabilities are going forward for the federal government. So if you use actual accounting methodologies, if you used good solid GAAP, the things that we require that corporations do, things that we require that corporate pensions do, where they have to look at future liabilities and current assets and make sure that the growth on those assets is going to be enough to cover the future liabilities. The federal government doesn't have that mandate. And if you start to look at the unfunded liabilities, Medicare, we're looking at $55 trillion of Medicare unfunded liabilities, Social Security over $41 trillion. Then you throw in the debt, you throw in military and civilian retirement benefits, and then other liabilities. Minus our almost $6 trillion of assets, we have a shortfall of about $123 trillion. Trillion. Okay, think about that. When our total GDP, total size of our economy, is 25 trillion. Federal government has 4 times that, just an unfunded liability. So something's going to have to be done with all these things. Whether it's, I would think military civilian retirement benefits should start to be pulled back a little bit. They're pretty damn generous. I think we should, in some way pull those things back. That's just me talking. But clearly the biggest targets are going to be Medicare and Social Security. So how are they going to close that gap? And I'm talking bonds. Bonds eventually end up driving all of the other markets. Everything is predicated on bonds. And you can see this year across the board around the world, bonds are losing value because interest rates are going up. The bond prices are coming down. In fact, this is a very busy graph that shows the Bloomberg Global Bond Index return. And thus far, this has been the worst performance by a bond index ever. So the next closest one is 1999, where by the end of the year it was down 5%, but we're already down over 8% in bonds. And this will give you a little bit more to kind of give you an idea. This is 2-year Treasury, just a long-term trend. Long-term trend lines don't really mean anything. It doesn't mean things are going to happen, but it kind of gives you a little perspective. I like to look at these things just to give me an idea. Now, clearly, can the economy function with bonds, 2.5% for the 2 years? Sure. If this chart doesn't mean it goes above that and things collapse. It just means we're breaking a long-term trend. But you can kind of see anytime we reach these levels, things have gotten a little bit hairy. And this is another graph only looking at the 10-year Treasury. I think I showed this last time. I can't remember. But this chart goes all the way back to the 1980s. And you can kind of see we've been in a tight range. And anytime it's pushed up against the top of that range, we've had some sort of big issues that happen that cause it to come down. Now, when you look at this graph right here, it was dated on April 8th. And it's got the 10-year Treasury over, if you look at the far right, at 2.6962. As of yesterday, the 10-year Treasury, only 7 days later, is now at 2.87. So that's a huge jump. So we're well out of this range now. We are busted quite a ways through it. Again, can the economy function on sub 3% yields? They should be able to. You'd think they would be able to, but we'll see. We'll find out. But we have broken some long-term trends. And it could be safe to say that the 40-year bull market in bonds might be over. And as I mentioned, global value of bonds is dropping. This is just chart showing, amongst a lot of different euros from the 1 year to their 5 year, they're losing value too. Again, they're still at the low range. It's not as if it's 5-6%, but you have to look at this and say, well, when you have a stock market and real estate market that is just doing so well because of this liquidity and low interest rates, what happens when it reverses just even a little bit? And speaking of mortgages, we now have the 30-year going up above 5%. This was, I think, April 11th. Okay, so it's 4 days old. So I think we're already at 5.35%. So not real pretty. And this sort of gives you a rate of change for the 30-year rate. So it is moved awfully quick. And this is going to start to have an impact. It's moved so fast that maybe you still hear about having 40 bids for a house and overbidding for the house, but that's going to end really quickly. Now, you might still have cash buyers that come in and they're going to be stupid with their money, but they're cash buyers. And the thing is, if stock markets pull back, things like that, you're going to see these cash buyers go away, or at least start to be reduced drastically. And you're going to be forced to do what most people do, is take out some sort of mortgage debt. And they're just not going to be able to get as much debt now because the rates being higher. And this is another good way to look at it. You can see as the 30-year mortgage rate has gone down over the years, that has been the fuel that drove home prices. So what happens as this thing reverses? What happens to home prices? I mean, it's pretty simple to see it, but if and I said this last time, if you have a home that you've been thinking about selling, maybe second home, maybe a rental property, do it. Get rid of it. Unless it's going to be an enormous tax liability for some reason. But if you're looking to buy, just hold on a little bit. I know, especially women, that nesting, they want to have a house, they want the yard, they want all that stuff. But hold on a bit, you can get it at a much better price. I showed this last time we did it, just giving you an idea of the level of home prices, clearly way above where they were in 2006 at the peak. So what does that mean? Now, granted, inflation is a little bit different, so you don't expect it to be at 184, but I mean, it's clearly at levels you can't keep it going. And all of this, the inflation, all of that is starting to really affect consumers, as you could probably expect. So this shows you that, we're now getting close to levels from the University of Michigan Consumer Sentiment Survey that we see at the bottom or, at the peak of recession. So, we're getting there. And that's sort of what I think is probably going to happen. And this chart sort of shows it. I think when bond rates go up this quickly, it's going to have a big impact once it starts to manifest itself into the economy. It's going to impact everything. It's going to slow us down. It's eventually going to be the point where people start selling stocks and other assets, and they'll run back to bonds because bonds are still seen as more of a safety valve than stocks or commodities or real estate. So I think bonds will actually probably do well from here on out. That's my guess. It might be a little bit of time before they start to turn, but I think the pain is going to start to show up in other asset sectors like the stock market. This graph, the reason I'm putting this up here is to show you the 1970s. We actually had a period in the early 70s when inflation really started to rise, due to the guns and butter policies of Lyndon Johnson and continued into Nixon. But we got into the recession of 74, and I'm sure, probably there's enough people watching this that remember that one. That was a doozy. And what happened is interest rates went up quite a bit to the point where it affected the stock market, it affected real estate, affected all of that. It affected consumer sentiment, the inflation, the interest rates. It basically brought on a recession. Recessions are deflationary. Okay, so if we have a good recession, that will take care of the inflation problem. Now you got a recession, but it does fix inflation. So, you're kind of no good outcome here. The Fed's going to try to thread a needle, but good luck to them. But what happened in the 70s is you had that 73, 74 recession. Prices pulled back, interest rates came down, but you still had the underlying pinnings of inflation in that period. You still had massive government spending, out of control spending. You also had an issue where you had a commodity bull market. On top of that, you throw in, the oil embargo. And people always talk about it. They blame the inflation of the 70s strictly on the oil shocks, which were a big part. I mean, don't get me wrong. But if you look at the commodity boom of the 70s, it was everything that went up. I mean, it was gold, it was silver, it was industrial metals. You had grains, you had everything, livestock. So it was across the board, kind of like what we're seeing right now. So you had the recession, kind of got through the recession, and then inflation just continued to pummel and went back up. And so finally, in the late 70s, Paul Volcker, the Federal Reserve chief back then, said, we're going to stop it. And boy, he did. That's where he raised interest rates well above the rate of inflation in order to stop it. And that it caused another big recession in 1981. So he and Ronald Reagan, basically said, we're going to take some short-term pain, but it'll fix the problem. Reagan had a lot of capital at that point because he'd just been elected. So, he didn't have to worry about midterm elections. He didn't have to worry about, obviously, a presidential election at that point. So he took, it's probably the last time that you had government officials say, we're going to take some short-term pain in order to have some long-term gain. But that's kind of what I think we're going to see here. I think anything the Fed does, they're going to, if they do 9, 10 interest rate increases, it's going to, it's basically going to cause a recession. Absolutely going to cause a recession. Stocks are going to get smacked. Real estate's going to get hammered, everything like that. But it will stop inflation in the short term. The problem is we're kind of facing a longer term inflationary problem. These things last for years. This is a pretty busy graph. Big thing to look at is the periods of blue or commodity super cycles, periods of green when commodities aren't doing all that well. We've basically kind of entered a period where I think we're seeing commodity boom. So the next anywhere from 10 to 20, maybe even 30 years, you could see a period where commodities are basically going to be more expensive. So the underlying economic theme is going to be inflation. And when you look at what's going on in the world today, I think that's clearly going to be a case for a few years. With what the Russia-Ukraine issue, that's going to have a big impact on commodity prices for years to come. Even if you have a war settled right now, it's going to take some time to get this thing back to normal. But the bigger issue is more along the lines of Russia moving away from the US dollar and now taking things like gold. You're getting to the point where we're going to start to see, rather than the world using just strictly dollars to commence trade, they're going to use commodities. They're going to be trading in oil and gold and silver, all that kind of stuff. So as we kind of move away from the dollar denominated world economy and more of a commodity based, you're going to see the demand for commodities go up, and that's inflationary. So what I'm expecting is to actually see bonds start to do pretty well from here on out for the rest of the year, only because as the Fed really starts to, pull rates up, it's going to affect the rest of the economy, and we're probably going to go into a recession. So that's sort of what I'm thinking. And of course, I always like to leave it with, lawyers say hi. Don't take this as financial advice. Please check out, we're going to relaunch our Saving Yourself from Wall Street and Picket Fence websites. Going to have both of them on there, but the Saving Yourself from Wall Street, I'll have a lot more information. Highly recommend you take a look at that if you have an interest. So it's going to be interesting to see what goes on here. But I started to put a little bit of money, a very little bit of money in long-term treasuries, like the 20-year treasury ETF. It's been getting smacked around. I waited till it was down substantially. It's continued to go down. But I do think we're going to probably see a little turn here, mostly because we're going to probably enter a recession. Recessions are deflationary. You'll see inflation come down a little bit, at least temporarily, but the longer term underpinning here for probably the next decade is inflation. See if we got any questions. Get some good comments from Rob. How does one inflate our way out of the debt? That's a good question. Well, it basically makes the debt worthless. So that's the thing. I always give the example when I talk about it. I remember my dad, he bought his first house, grew up in Flint, Michigan. In the 70s, Flint was still a really good place to be. So I think it was 72, they bought their house, paid $26,500 for it. He was just a school teacher. Mom stayed at home. And he was worried about that mortgage. He coached, he loved coaching, but he did that also for the pay. And then he worked on the summers, did odd jobs, things like that to make sure he could make that mortgage payment. It was, 10% interest rate. And it was tough for them to buy that house because home prices were still pretty good in Flint at that time. But as the years progressed and we got to the point where inflation ravaged throughout the 70s and the early 80s, and we got into the, I remember in 83, 84, my dad kind of laughing at the mortgage payment because, dollar was worth so much less. I mean, he was making more due to inflation, everything like that. So that mortgage payment wasn't, it wasn't even worse than the car payment. So, and incidentally, they ended up buying another place, but they bought another home in 91, just outside Flint, a nice little town. And it didn't go anywhere price-wise up until a couple of years ago. It went flat. So from 91 until 2016, 2017, they could only sell it for what they bought it for. It didn't go up at all. That's more of an underpinning of the Flint economy than anything else. But it just kind of goes to show you things on real estate. And that's how they inflate it out. So if the U.S. government can basically take the debt they've got and then pay back the people who borrowed money or they borrowed money from, and the dollars are worth less, then they basically inflated their way out. Now the problem is I'm sure you're probably thinking right now, is if that only works if you have a consistent debt. So you go back to my dad's example. He paid $26,500. That was his debt. That it wasn't going up, right? Every payment he made, it went down. So inflation helped him in a way, because all of a sudden, his pay went up with inflation for the most part, and he was paying back a mortgage with dollars that were worth less. But it was a static amount of debt. The U.S. government's not going to do that. The U.S. government, as I showed you, with unfunded liabilities, they're going to have more and more debt. This is only getting started. So you can't really inflate yourself out. If your mortgage is getting bigger every month, every year, inflating yourself out of that just doesn't work because you're always going to be taking on new debt at inflated rates. So it just doesn't work. So all these people that keep saying they're going to inflate their way out of the debt, I don't know how they do that, honestly, because the only way you can ever truly inflate your way out of your debt is to have a set amount of debt. Now, I have actually recommended to clients that they take debt. I've got one client, his wife thinks I'm crazy. I'm pretty sure he agreed to it, but she thinks I'm crazy, but they took out some debt on the house that was paid off. And because I'm like, you've got a set amount of debt that's going to go down over time, but your dollars are going to become worthless or more worthless or lose value. I shouldn't say more worthless, but they're going to lose value. So you're going to be paying this debt back with money that's worth less, but they have a set amount of debt. That's where inflation could actually help you. if you're highly leveraged, but you're not taking on more debt, it works for you. That's the biggest thing. Unfortunately for the government, they're facing a situation where their debt's going to continue to rise, and so inflating their way out isn't. But that's kind of the current economic trend. When I do my presentation on the Fed, maybe I'll also throw on there, the latest hot economic theory that goes around DC called modern monetary theory, MMT. It's total kook job stuff. It's absolutely ridiculous, but for whatever reason, they're getting the ears of the government, mostly because the government has no option. So they're listening to the sort of crackpot economic theories, but maybe we'll get into that a little bit. That's, we'll be getting our nerd on when we do it, but it's interesting stuff. And I think it's good. You might have heard that MMT thrown around. It's usually associated too with, having that monthly $1,000 a month that they talk about, where everybody gets paid no matter what. And they can do that by using the theory of MMT. It's just printing money. It doesn't work. Never has. It's not going to. Okay. So anyway, that's basically all I've got right now. I said it last time. I'll say it this time, watch bonds. They're not sexy. You don't get a lot of news coverage on bonds, but they are going to drive what happens here. They're going to be the driver's seat. So, while you're jump on CNBC, or if you're looking at the news stations and they're talking about the stock market, ignore that and look for information on the bond market, because that's going to have the biggest impact. That's driving the train, and that's the conductor. And if these rates continue to go up, you're going to see some dislocations in other asset classes. You might even see, another issue in the banking sector, because things, it could cause some dislocations there too. So watch bonds, watch what goes on, and let's see what the Fed really does. Are they just jawboning, trying to get things down? Or are they really going to, raise rates to try to slow down this inflation? I think they're going to really, at least at the start, do it until things get really unbearable, or we're completely in a recession and everybody knows it. So great news for Easter, huh? But no, I just feel, I know this has been a little bit negative, but I'm trying to just get out what I'm seeing, what I'm thinking, and making sure that you guys get this stuff. So it may not be what you want to hear, but I think that this is the stuff you need to hear. If you go and watch Jim Cramer, he says, oh yeah, the stock market pullback's over, it's onward and upwards. Yeah, that's what you get from that station. Here you're going to get, hopefully I'll give you a little bit more better analysis, and I could be wrong too, though. I know that, but at some point, some of these things are coming to fruition. It's getting to be just mathematics at this point, with the amount of debt that we have, interest rates, everything like that. So, okay. I hope everybody has a great weekend, and we'll see you back here in a couple weeks. So take care, everybody.